Hello, my name is Robert Belsky, and I'm going to be doing the financial analysis of the Vanguard Group. The Vanguard Group is not a publicly traded mutual fund company, so I haven't been able to gain access to its financial statements. And this is going to make the financial analysis a little basic, but I think it's quite meaningful. Vanguard is client-owned, which means that the shareholders are the mutual fund investors. Essentially, what happens is, after all the investing activities are done and the fund generates revenue, if it generates revenue, this revenue is distributed amongst the fund shareholders, much like dividends. And this gives us an idea of the basic business structure, so then we can go on to the meaningful financial data. So the company claims to have almost $1.3 trillion worth of assets under management. This would make it one of the largest mutual fund companies in the world, and would mean that there are quite a few shareholders of Vanguard. They offer 210 funds, 160 of which are domestic, and the rest being foreign. This means that the majority of the shareholders are domestic shareholders, and as a result, they're probably a domestic-based company, and I think they're based in Valley Forge, Pennsylvania. The expense ratio is 23% of their net assets. We can estimate that their total expenses, this consists of paying their managers, maintaining their offices, and any other administrative expenses, equals about $299 million if the $1.3 trillion worth of assets is the true figure. So this expense, this $299 million, is allocated across their various funds and lowers the total return slightly. It's difficult to say, with the limited information available, whether the company has any debt or whether it has any, if it's made any investments besides their core business. But according to Bloomberg, they took out a loan on one of their offices. It was to refinance their previous mortgage, and realistically, a company as large as this is not really going to have a problem meeting their debt obligations if it's something as small as this. In order for that to happen, their net assets would have to drop substantially. But their growth seems to suggest that they're not in any trouble, and you shouldn't really be worried about their core business. They have roots that go back to 1929, and the Vanguard Group was actually started in 1975, so it's seen its share of recessions, and it's seen its share of booms. It's grown so much that now it's the primary competitor of Fidelity and other large mutual fund companies. And the way that it did this is it's a no-load fund. So it means buyers do not pay sales commission. The way that it works is how we explained. The expenses are paid, and then the revenue is distributed. So this mix seems to have appeal for both retail and institutional investors. And the only way I can see it continue to grow would be to begin to expand their fund offerings. They would have to target new demographics, and they